3i Group shares jumped 10% on Thursday to 2,483 pence after its AGM trading update revealed Action's like-for-like sales growth of 3.3% for the year to 21 June. That is the top-line fact. The tension is that 3.3% sits below 3i's own full-year guidance range of 4% to 5%. A below-guidance reading produced the biggest single-day gain on the FTSE 100. The bottleneck explaining this apparent contradiction is not the LFL figure itself. It is what floor investors had already priced in before the update arrived. Earlier this month, Citi analysts estimated the market was implicitly valuing Action on just 2.2% medium-term like-for-like sales growth. Against a 2.2% implied expectation, a 3.3% actual reading represents a meaningful positive surprise, even though it remains below the company's stated target. That gap is the entire logic of today's move, and it is also the reason the move is fragile. A stock that rallies because it beat a market-implied bear case, not because it confirmed its own growth thesis, leaves holders in a structurally ambiguous position. The falling question began in earnest last November, when 3i shares plunged 17% after Action missed sales expectations. That collapse sent the stock from an all-time high near 4,500 pence to lows below 1,900 pence in recent months. Today's update arrested the slide, but it did not reverse it on the evidence of Action's fundamentals. The 3.3% LFL figure is carrying more interpretive weight than any single data point should bear. Citi read the market's pre-update pricing as encoding 2.2% medium-term growth, a structural bear case for Action. The company's own guidance for this year sits at 4% to 5%, a moderate recovery case. The CEO, Simon Barrows, declared the group set for a good quarter of profit growth and pointed to 105 new stores opened so far this year, on track for the 400-store annual target, an expansion case. Three separate verdicts drawn from one number: structural deceleration, moderate recovery, and continued expansion. The articles do not resolve the conflict. What they do record is that today's market moved on the gap between Citi's 2.2% floor and the actual 3.3%, not on evidence that the 4-5% annual target is achievable. That distinction matters because Q1 LFL was 3.6%, and the year-to-date figure through June 21 stands at 3.3%. The trend within the year is therefore decelerating, not stabilizing. The consensus hidden assumption is that 3.3% represents a floor, not a trajectory. The experiences division parallel is instructive here. Moonpig, also reporting FY results today, saw its experiences revenue fall 4.5%, while the headline Moonpig brand grew 8.6%. Market reporters noted these as separate tracks. Action faces an analogous earlier months showing mid-single-digit LFL declines before recovering. The France story is not resolved. One article noted France returned to 2.1% LFL growth in January, but the June year-to-date aggregate at 3.3%, including France's partial recovery, still trails the guidance midpoint. The 10% gap up is easier to understand when placed in today's broader market context. Brent crude fell 1.2% to $72.88 as tanker traffic through the Strait of Hormuz resumed following the U.S.-Iran ceasefire framework. Susanna Streeter at Wealth Club described the session explicitly. Energy efficiency measures adopted during the crisis, coupled with fears of slowing global growth, are contributing to the bearish outlook for the sector. The pivot away from energy and toward defensive growth names with European consumer exposure is the day's stated regime trade. 3i Group is the only FTSE 100 vehicle offering direct listed exposure to pan-European discount retail at scale. Action's 65% ownership stake, valued at €22.38 billion as at December, constitutes the overwhelming majority of 3i's total portfolio. When the market's risk rotation on a given day moves toward European consumer resilience and away from energy, 3i is the instrument that captures that flow. The LFL number provided a catalyst. The regime created the amplitude. This is the point most holders will miss. The 10% move is not purely a bottom-up response to Action's trading update. It is a top-down regime-fit trade that found its trigger in the update. The risk for holders who interpret today's move as a fundamental vindication is that regime trades unwind sharply when the catalyst for the rotation, here falling oil prices and a Middle East de-escalation trade, reverses. Action's LFL would need to hold at 4% to give the move durable fundamental support. CEO Barrows stated at the AGM that Action is set for a good quarter of profit growth. That phrasing is the single forward checkpoint from today's update. It refers to the quarter ending in late September, with results expected thereafter. It is the variable that most sharply discriminates between the two reads now competing, 3.3% LFL as a trough and reacceleration versus 3.3% as a decelerating run rate converging towards Citi's 2.2 bear case. The holder's monitoring variable is simple. Does Q2 operating profit growth at Action come in at or above the growth rate implied by the store count expansion of 105 new units? If new store volume compensates for the LFL softness and total profit grows, the expansion case read survives. If LFL continues to decline toward or below 3% while profit growth slows, the Citi bear case, 2.2% medium-term LFL, looks prescient rather than pessimistic. The watchlist candidate faces a different question. At 24.83 pence, 3i still trades well below the prior all-time high of 4,500 pence. The implied discount reflects the market's uncertainty about whether Action's growth rate has permanently decelerated. Entry before Q2 confirmation means taking on that uncertainty. Entry after Q2 confirmation means giving up part of the re-rating if the result is strong. There is no dominant entry. The choice depends on whether a buyer prices Action at Citi's 2.2% or 3i's 4.5%, with the actual number landing somewhere between. The read that reverses, if Action Q2 profit growth comes in below the prior year's comparable, any year-over-year decline in operating profit, the recovery thesis breaks regardless of LFL, and today's 10% rally becomes the exit window in retrospect. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.